Good evening, everyone, and welcome to the Creation Care Task Force at St. Timothy's Church. Conversations about low-carbon sustainable investing tonight. I'm Bill Shreve, the leader of the Creation Care Task Force. In this series, we hope to start conversations about climate change and creation care that spur people to action. We believe that faith groups are well positioned to lead this movement to harmonize our lifestyle with sustaining creation. We can do this working as individuals, as communities, as a nation, and as an international leader. Our series of conversation focuses on how we can start this work by our individual actions. Faith is the key, and God works wondrous ways through people of faith. We're going to run the meeting a little bit differently tonight because it's going to be a slightly smaller meeting. And so if you have questions during the meeting, please unmute yourself and ask the question, or you can ask it through chat, and Jenny will present the question to Patrick. The decisions we make in our daily lives contribute about 40% of the greenhouse gases emitted by the United States. We can make a difference through actions that reduce carbon in the atmosphere and thereby slow the deleterious impacts of climate change. In previous talks, we've learned about what is appropriate for those of us in faith groups to lead this effort. We have learned the impact of energy choices, of waste generation, of regenerative gardening, food choices, and the impact of public policies that disproportionately impact the poor and communities of color. All these talks are available for you on YouTube. Tonight, we'll hear how our investment decisions, savings, pensions, and 401ks also have an impact. Let's start with prayer. Let us pray. Almighty God, in giving us dominion over things on earth, you made us fellow workers in your creation. Give us wisdom and reverence so to use the resources of nature, that no one may suffer from our abuse of them, and that generations yet to come may continue to praise you for your bounty. Through Jesus Christ, our Lord. Amen. Our speaker tonight is Patrick Costello. He's a certified financial planner professional and the founder of Green River Sustainable Financial Planning in Marin County. His book, Low Carbon Investing, Defending the Climate, Emphasizing Performance, was published in 2018. Patrick also leads the fossil fuel divestment investment team of 350marin.org and serves on the board of Fossil Free California, an organization working with California pension plan trustees, urging them to divest from coal, oil, and gas stocks. So now, Patrick, I'll turn it over to you.
Good evening, folks. And thank you very much. Thanks to Bill and thanks to Jenny for inviting me to be part of your Creation Care discussion series at St. Timothy's. I've got a fairly long slide deck here. I'm going to move through pretty quickly. And I will respond to questions that come up that seem urgent about a particular slide. We'll pause after every, I don't know, when we come to certain slides that seem to bear additional scrutiny, maybe we'll pause there. A lot of times in a longer presentation, an hour or more in the evening, it's good to take a little break after 20 minutes or 30 minutes. So we'll kind of improvise as we go on. My last presentation, I read from a script, which really does help in a way. You like to get your language and your verbalizations as accurate as possible, but I'm going to be a little more conversational this time and kind of follow the PowerPoint slides. So here we go. This is essentially what we do at Green River. You could kind of put the whole thing into three different categories. You know, our number one, the thing that really makes us different is our approach, the sustainable low carbon investing approach. Very, very, very few financial organizations actually focus in this particular area. Here is some of our contact information. We've put a lot of work into our website. Our recent presentation where we had 3 or 4 other people from the sustainable investing world with me is, it's on YouTube and there's a link to it on my website, the greenriverfinserv.com. And there's, I think it's a pretty robust explanation of what we mean by low carbon sustainable investing. So Bill covered this quite well. This is just useful for the picture of the book cover. Pretty accurate, pretty recent information. I actually published my first book in 2013, and then I updated it in 2018. Things had changed so dramatically, especially around climate and what we know about. It just seems every couple of months, the scientists seem to have a little scarier assessment of how quickly the planet is warming. So I updated that for 2018. This is our mission statement. We help clients align goals and values with their investment strategy. This is kind of from a Bill McKibben statement that climate change is real. It's us. Scientists are sure. There's no doubt about it. I want to make the point, and this presentation will be organized around the point that divestment from fossil fuels in your personal portfolios and in your retirement accounts makes a real difference. And the other thing that shouldn't even be questioned any longer, although there are still some people that haven't gotten the message, screening investments for sustainability and carbon footprint can enhance performance, and they certainly don't detract from performance. I am anybody that does what I do has to have a compliance regulator. I had to present this entire slide deck to them, and they vetted it, and I had to include this particular disclosure to people, just common sense things that all investors should be aware of. So, as I've alluded to already, we at Green River advocate strongly for a fossil fuel-free, low-carbon investing strategy. And to be even a little more pointed and maybe be a little different from so many other financial service organizations who, let's be honest, are more like mercenaries than anything else, we literally will not accept clients, no matter how much money they have, if they're not on board with our primary concerns about reducing emissions and doing that by going as close to fossil fuel free as we can. So we're a little different. We actually have, we have a point of view that we're sticking to. Anybody that's looked at the performance of various parts of the stock market are well aware that I'm going to say that 2020 is the biggest divergence I've ever seen in my career, starting in 1994, between the performance of what they call the energy sector, which is generally considered to be oil, gas, and coal, and the renewable energy group, which now is considered more of technology, not so much energy. They've gone in completely opposite directions this year. The last time I looked at Exxon's stock value, it had fallen something like 40% this year. I mean, really 40%, and we're still only in October. They had a little rally a couple of weeks ago, but I think it's still somewhere around 40% down. Meanwhile, solar, wind, and funds that focus in those areas, it's almost scary to say, it's almost like a jinx, but they're up 40, 50, 60, 70% in some cases. So the numbers are dramatic. One of the points I like to make is that low carbon investing is actually a subset of these other categories, these other acronyms that you hear bandied about. Like the oldest acronym around is the one that's been used for decades called SRI, which stood for socially responsible investing. The new acronym is ESG, and I'll explain that a little further. But all of those investing strategies where we evaluate companies for how they treat their employees, how they treat the environment, and how they govern themselves, kind of falls under the general rubric of sustainable investing. And there's an organization that does an assessment every 2 years, and they're going to come out with a new report in a couple of months. But right now, the latest numbers show that over 1,000 institutions have divested 14.5 trillion. Pension plans all over the country are divesting from fossil fuel stocks. You know, coal is usually the first thing they get rid of, and then they start thinking about oil and gas. Exxon was actually dropped from the Dow stock index. I mean, that's pretty shocking. And then to kind of add insult to injury, an Exxon internal plan was leaked on October 5th that they literally plan to increase emissions through 2025 by an enormous amount each year, going in the exact opposite direction of the Paris Climate Accords, obviously. So I just like this little visual. Wouldn't you rather have that little svelte, compact green footprint instead of that big, ugly, oily one? This is a super important slide. And this is the one that I think the average person, even people that are really tuned in to being highly concerned about climate change, lots of people in the Marin community, they don't get what a big piece of your personal carbon footprint is represented by your investments. So this is a careful, highly validated analysis done by a Canadian outfit that does research for their pension plans. So you can see, look at the difference, the impact. Or now, just to be clear, we're not telling you that we're going to completely eliminate the carbon footprint from your investment portfolio. We're talking about reducing it, but we're starting from a really giant number compared to just getting an EV. All these things that we aspire to that seem relatively simple, getting an EV, cutting down on airplane travel, all of those good things. If you can reduce the footprint of your investment substantially, you can really make an impact. So here's a little diagram it's kind of the overlapping Venn diagram. It's pretty obvious. We're not looking for companies that are doing poorly. We're not looking for companies that have products that aren't going to succeed in the marketplace. We're looking for that overlap, that sweet spot between companies with strong investment potential and then high sustainability scores. And again, I'll talk a little more about what ESG actually means. I go into depth on my website explaining what that is. Here's a little visual right here showing that ESG stands for the environmental, the social, and the governance impacts of a particular company. Here's another little way of looking at it. And as I said, low carbon investing is a subset of ESG investing. ESG investing, as you can see by how broad that three-piece lens is. I'm going to talk about this later, but unfortunately, ESG can be used to camouflage funds that are still heavily invested in fossil fuels because they have their list of priorities, and reducing the carbon footprint might be fairly far down the list compared to some other things around the governance of the company and some other things. So this is yet another reminder that we need to tease out the details of all these things. As I alluded to earlier, we've got these terminology issues that can be very confusing. Essentially, these are all the same, and I'm going to treat them as if they mean more or less the same thing. Ethical investing, ESG, impact investing, you'll see that a lot. Sustainable, socially responsible. This is a number that's pretty impressive, just kind of the ratio. Really, at the beginning of 2018 compared to the beginning of 2016, this study that's done every 2 years ascertained that 1 out of every 4 invested US dollars is within that rubric of socially responsible, sustainable investing. And we anticipate that the number is going to be closer to 1 in 3 or maybe 1 in 2.5 by the time, 2 years have gone by. The new report's going to be out in a couple of months. And they have a good website too. It's USSIF, Sustainable Investing Trends. It's a forum for sustainable and responsible investment. There's even, I hate to tell you, this is kind of like a trade secret, but they have a list of all of the funds from fund families that are committed to sustainability, organized by type. You could almost build a portfolio from their internal list, but don't tell anybody I told you this. So this is important for people to understand here. This is a new slide that I added after sort of thinking about my last presentation. I want people to really get clear on the difference between building a portfolio of funds versus picking individual stocks. I'll even pause here for a second to see if any questions arise. What we do at Green River is we build a portfolio of funds. For a small portfolio, like $100,000, maybe there's 4 or 5 funds. For a $5 or $10 million portfolio, there might be 12, 15 funds in that portfolio. And we do some very challenging and difficult and important work. We use some really cool software to really, what we do is we try to figure out, it's part art, it's part science. What is the client's risk tolerance? How much of a loss can they tolerate in the short term if they realize that there's a trade-off? If you're willing to accept a certain amount of volatility, then over the long haul, you should make more money than someone who accepts less volatility. So we design, we assess that risk tolerance, and we build a portfolio of funds, and we can move we can go from a 60-40 stock to bond ratio to a 50-50 to a 40-60 if we think that the international economic environment dictates that that's a prudent thing to do. So we do a little, as we say, tactical timing. We don't just buy and hold forever. That doesn't make sense to me. And I take responsibility for all of those decisions, by the way. I don't offload it to somebody else in an office somewhere, 3,000 miles away. Now, the fund companies are the ones that choose the individual stocks and apply these ESG matrices that I'm talking about. And we're going to look at some of their process later on during this presentation. But is that clear? We build a portfolio of funds, and we can move in and out of stocks and bonds very quickly by just selling shares or buying shares of a fund on a trading day. Whereas a fund company, if they have a stock fund that specializes in large cap US stocks, they can't exit that position, even if the market, if it's, remember 1987 when the market dropped 20% in one day or whatever it was? A fund company can't just exit its positions. It's got to, it has, its prospectus determines what it's focused on. So you're kind of stuck if you're just in a fund. So we add that other element where we can do some movement if necessary. But the fund companies do that very difficult, challenging role of analyzing these companies, seeing what their fossil fuel exposure really is, and then building their own portfolio. And we use funds for these reasons. You get automatic diversification. A particular fund probably holds 50, 75, sometimes 100 stocks in one fund. So with one transaction in one of my client accounts, I can, by selling all the shares of a particular fund, we can completely either exit or take on exposure to a whole group of stocks or bonds or a combination of the two. So there's the trading ease, there's the expertise that you get. Every fund family has professional fund managers. Usually it's a pretty big team that does all that analysis about when to buy a stock. It's not sufficient just to, figure out if there's a good company out there like a Tesla. A fund family has to determine when to buy Tesla, when to sell Tesla. And those are very tricky, challenging decisions, and you need a good system to help you do that well over time. Performance, sites like Morningstar, Yahoo Finance, you can immediately look at 5, 10, 15, 20-year track records of funds. So you really can see how they've done through good years and bad. And the daily pricing, the transparency, the ability to, the liquidity, you can get out of a fund entirely on any given trading day for the most part. So that's really why we use those. So within the fund universe, which comprises, 12, 15,000 different funds, there are a subset of sustainable fund families that by definition have a sustainability commitment. And I typically, I start with those. Those are the fund firms that I look to for most of my client accounts to build those portfolios. But I also will go to another fund family if they have really clean funds. T. Rowe Price happens to really have some good active fund managers, and I use one of their large cap funds because it's just got unbelievable performance, and it's also utterly fossil fuel free. But our first allegiance, shall we say, is to sustainable fund families.
Patrick, we have a question.
Okay.
How do you avoid overinvesting in one stock held by multiple funds? I imagine that might be such as Tesla. Tesla is in everybody's funds, it seems like.
Yes and no. That's one of the jobs that we have when we're building our portfolios, is to make sure that we pick the funds for a client that they don't all have the same holdings. You point out something very important, and that is something that besets a lot of, let's say, non-professional or amateur investors. They may not realize that a Fidelity fund and a Vanguard fund hold substantially the same stocks, but our business is to know that kind of thing. So we address that when we build the portfolios. So on my former presentation, I had Erin Gray on the call, and she kind of went through her slides. I want to just kind of introduce you briefly to the Green Century Fund family. They're a super clean fund family. It's a very interesting organization. It's one of the few nonprofit mutual fund families. Every year they publish a very useful investing guide with 350.org and Trillium Investment Management. And they've got 3 funds. They're not a huge fund family, but their funds are quite good. And I particularly like their international fund. It's not easy to invest in large international companies, companies that are based outside of the US and utterly avoid fossil fuels, and they're able to do that. So this is kind of who they are. That's a little subset of their 3 funds. This kind of shows you the sort of thing that a sustainable fund family, how they organize their process. They avoid certain industries. They've got screens, you know, and every fund family does it differently. They are big advocates of fossil fuel-free investing. And, you know, this used to be a problem 5, 6, 7 years ago. And I have to say that the people who really put this message that is no longer true out there were typically people who worked for organizations that built their own funds, which is one of the classic conflicts of interest that is rife, I'm sad to say, in the financial services industry. Most of the people that you encounter who are in the business are with a group that actually makes, manages, and offers their own funds. So there's an inherent conflict of interest in that situation. So this whole myth that you somehow make a performance sacrifice, let me just turn that on its head. What we have realized, those of us who understand how sustainable ESG investing works, is that it actually gives us a better tool, a better lens through which to look, in conjunction with all the, you know, there's certain classical lenses that investors always use about what is this company well run? Do they have a product or a service that is projected to do well going into the future? Those things are not going to change. But we then add this ESG or sustainable investing lens, and we have learned that that actually enhances performance. We're able to tease out some information about companies that professional investors used to ignore in the past. So it's the opposite of what people were told a few years ago, that you're making a performance sacrifice. No, we actually have a better tool for finding better companies through these funds. And here's an example that she included in her presentation of 3 different companies that were chosen for their, I don't know, all of their funds for the, probably they have an all stock fund, an all US stock fund. They have a balanced fund, and the word balanced almost always means part stock and part bond. And that's for investors that don't want to take the risk of owning a fund that's all stock. So these are 3 of the companies that they've identified that they, after going through their screening process, they've decided are appropriate for their funds. And you might be surprised to see a Starbucks, but you know, one of the things not to, I like to make 2 points when you see a company that's kind of a household name. First of all, if you are going to be so pure with your investing that you're not going to hold any large US companies, you're not going to be very diversified. And if you're and if you're okay with that, fine. But most of the people I work with are not philanthropists yet. They need to get a good return from their investing. So they can't just jettison all large American companies. And I don't think you can find a large cap household name American-based company that doesn't have something about the way it does things that you don't like. And the other side of that is, you take a Starbucks, if you're able to change the way they do things, and I'm alluding to something that I should be more particular about. One of the great things about sustainable fund families and using them, excuse me, to choose the stocks in your portfolio is that they advocate on our behalf. They can actually file shareholder resolutions with these companies. They can actually make a phone call to the executives in these companies and explain that, hey, we have hundreds of investors who have entrusted us with their money, and we're considering buying some of your stock if you'll change A, B, and C for these reasons. So they did a lot of work with Starbucks, and they got them to make some changes, even to their container, so that it's, I think Starbucks is now using a recyclable container. I'm not sure about that. But this is just an example of sort of the internal workings of some of the green fund families. And this is more about the shareholder advocacy that they're involved in: proxy voting, company engagement. And so when you aggregate many investors with a fund family, you can really have an impact, and you can sway some of these executives to make better decisions with regard to some of their corporate behaviors. And notice that doesn't apply to fossil fuel companies. They're in a completely different realm. And that you'll hear that pushback. We even get that, I'm on the board of Fossil Free California, and we're constantly putting more and more pressure on the two giant pension funds to get rid of their fossil fuel stocks. And the excuse always used to be, oh, we can't do that. We'd lose our quote unquote seat at the table. That doesn't work with fossil fuels. It really doesn't. They're in business to extract, ancient reserves from the ground and then burn them or find other ways to use them, building plastic, whatever it might be. There's a long, you can find discussions about this from Bill McKibben. Even that data point I just gave you a few minutes ago, that internal strategy piece that was leaked from Exxon, they're pretty much impervious to small shareholder pressure. The only thing that they really seem to understand is divestment. And even that, they sometimes try to weather the storm, so to speak. But with many other companies, you actually can have an impact when you go through a sustainable fund family that aggregates its investors and actually makes contact with the company through shareholder resolutions and other ways of communication. So here was one particular case study that we highlighted with Green Century about honeybee. Obviously, honeybees are absolutely critical to the world's food supply. And we're still not, the scientists haven't identified every single reason, but we're pretty sure that's got quite a bit to do with pesticides. So this is just sort of a historical perspective. When Green Century engaged around these issues with, I think, Nabisco that owns Cheerios, or General, I don't know what they mean about GM. And we're going to talk a little bit more. You see, they talk about an organization called As You Sow. We're going to talk, we might even visit their website if we still have time later on, because that's one of my primary sources of information about what funds actually hold. So this is the kind of thing that when you entrust a fund family like Green Century with part of your investment portfolio, you get the added benefit of being part of these shareholder engagement processes. So as I said, they have a very unusual structure for a mutual fund. 100% of the profits belong to the nonprofit owners. And now we're kind of flashing back to SB 100, which was a big step forward in California. This is kind of a list of their various engagements over the past just a couple of years, really. So find out what you own, divest, and then reinvest. And I have another presentation when we're just talking about banks. I have a link on a website called Banking on Climate Change. There's a big study that's done every year by the Rainforest Action Network and the Sierra Club. And we know now that the big corporate banks are responsible for loaning a lot of money to the most extreme fossil fuel projects in the world. So that's Green Century. So PAX is another, are we okay? Do people want to ask a few questions or take a little mini break or anything?
I think it was that we were hoping to back up just a little bit on the Green Century slide 12. Green Century Fund slide 12, just a few back. It had this one. Is this what you wanted to see, Joanna? To talk about this? So this is.
I just wanted to see it because I didn't get a chance to read all of it. And, it looks as though it's pretty interesting.
It's very weighty. It's a lot of information. And Patrick, I know he has a lot of things to share with us. There's so much in this realm. So thank you, Patrick.
Patrick,
Sure.
I had a question that kind of relates to the shareholder activism to get companies to change.
Yes.
I had heard that there is a group in Europe that's, I know the Church of England has their pension fund invested with them. that it's a group of different pension funds that are many trillions of dollars. And they claim to be able to work even with the fossil fuel companies to get them to change things. Things like you may have, I'm sure you heard that when Shell said they were writing off assets that were in the ground in some of their oil fields because they knew they'd never be able to take them out. And to write that off on your financial statement is a big step, as you know. And they did it. And I think it was probably because of pressure from these multi-trillion-dollar funds. Are you aware of any of that? And could you comment on it?
Yeah, I just say there's no perfect resolution of this whole discussion. I just think it's, and Bill McKibben from 350.org and others if you see what they're actually doing, I mean, they announce that they're going to do something, and then it's what are they actually going to do? They've been pressured for years, and they really haven't changed the way they behave. The only reason changes are happening now is because 2020 has been a terrible, terrible year for them. And they do realize that they have to make some changes just because of the lockdown and the pandemic. Of course, it really completely diminished the use of fossil fuels around the world. Also, the US and during the Obama administration, I might tell all you Obama lovers, and don't hate me for saying it that way, the amount of increase in fossil fuel production in the US, I don't think it ever increased more under any president other than President Obama. And that was one of the reasons why the price of oil got so low. There's literally an international glut right now, and there has been for quite a while. So some of the things they're doing, they're trying to kind of greenwash and use PR to make themselves look good. And there'll always be people, how can you prove that the group that you're referring to in Europe didn't have an impact? You can't prove a negative like that. So people have to kind of make their own decisions about what their stance is going to be. But the people that I respect the most in the environmental movement are crystal clear that a seat at the table with a big fossil fuel company is close to meaningless.
Thank you.
Sure. So Pax World Funds is a little bit bigger fund family. And one of the things they really emphasize is using what they call the gender equality lens or gender balance lens. We now have a lot of research showing us that companies that have a better gender balance in the executive suites and on the board make better long-term decisions, which translates into better stock performance over time. So that's one piece of the ESG lens that Green River and myself are really focused on, because I don't know how many people on this call or on this presentation are aware of Project Drawdown. I surmise that many are. You'll notice that if you combine what they say the benefits to climate are of making sure that girls and women have better access to healthcare and better access to education, you combine those two and it's almost their single biggest aggregate reduction of climate emissions. And part of that is because when women can move into satisfying jobs and manage their own families, typically they don't have children as early. And it actually is a very natural way to reduce population increase without, offending anybody's religious sensibilities. So Project Drawdown literally considers taking care of women and girls well around the world as one of the most important things we can do. And PAX has kind of specialized in that. So I'm going to go through the PAX slides a little bit here too. And they have a bigger roster of funds than Green Century. You can see this is kind of like a short list of what they offer. So I think we're all really clear that the economy is pivoting ever more quickly. I mean, it's not pivoting at the same speed this year as it was last year. It's actually increasing in rapidity, moving to the low carbon economy. And if you're not preparing for that and anticipating where that's going to go from an investment standpoint, you're going to be left behind. That'll be a performance sacrifice. If you're still holding on to your fossil fuel stocks, your performance is going to lag your next door neighbor's portfolio who has jettisoned fossil fuel stocks. So these slides are just kind of reinforcing what most of us already know with some nice visuals. Obviously, we're moving away from the combustion engine to electric vehicles. We're getting way more precise. It's amazing. I don't know if you've read much about the kind of technology they're now using for farming, where they literally have a GPS and super robust software that tells farmers exactly when to water, where, down to the millisecond and the square foot of this giant corporate farm, which in and of itself might be a problem. We're much more in favor of family farms and other sorts of farming that don't involve these giant corporations. But they are using some very precise tools that do help with the impact of farming on the climate. So, I'm showing these slides from these two fund families just so that you understand that they have a robust process, lots of employees that are slicing and dicing all of this so that they can make the best decisions possible about what companies to own, when to buy them, and when to sell them. One of the things that it turns out that, socially responsible or ESG, sustainable investing, one of the things we are finding out is that lens allows us to anticipate risks and dangers in ways that we weren't able to do before. So it's one of the superpowers of ESG analysis. This is a fund that they really have done a lot of work on, where their number one criterion is at least, I think it's 30% of female leadership, if not higher, at the corporate level and on the board. They just won't hold a company, and that can be a problem, especially if you're investing internationally. There's very few Japanese companies that come anywhere near 30% female representation at the top levels. So that's one of the areas where we're trying to make more progress, and the data support that a better gender balance actually guides a company better. So this is the type of snapshot. If you're familiar with an organization called Morningstar, I use them a lot. They have their own carbon risk data now. So you actually could almost live within their universe and pretty much get most of the information you might want as an individual investor. They have the 5-star, 4-star system where they have 3 different rating systems, and the star system is kind of looking in the rearview mirror. How has this fund done over time compared to its peers? So they're just kind of identifying some of the issues within the gender equality lens that are examined in this fund when they're deciding what companies to own, what stocks to own with the fund. Gender diversity, pay gaps between men and women, that kind of thing.
Patrick, when they talk about gender diversity, is the goal a 50-50 balance or even a higher percentage of women?
That's a good question. There is not, to my mind, a specific target. They're just, because it's so distorted in the wrong direction right now, they're advocating for at least 30%. That's kind of their threshold, more or less. I don't think that they're aiming at a particular, I think we all hope in the world that at some point gender won't matter at all. It'll just be based on who people are and what their competencies are. But before we ever get to that place, we aspire to just having a certain amount of equality. Which
a lot of smaller companies take pride in being 100% women managed.
Yes, and that's great. And again, we're looking at publicly traded companies that have, thousands and thousands of employees, and we're looking mainly at not the, let's say, new hires as much, although that's I think also part of the equation, but first and foremost, looking at the decision makers at the top levels of bigger publicly traded corporations. I really think it's more of an inclusive idea more than an exclusive. I don't think they're trying to exclude or say that, anyway, I don't want to go off on a tangent about that. I hope I addressed your question a little bit. So they do the gender analysis, then they use their ESG lens. And, every fund family has a very intricate, robust process. And our expertise at Green River is we monitor these funds' performance. We monitor their particular sets of criteria, what their priorities are. And a little bit later, we'll go to a website, if I think we'll have time for that. And I'll just show you that we can look into other things as well. We have ways now of looking at everything from does this fund hold companies that are involved in weapons, palm oil, deforestation, tobacco, all of those things are also part of the overall matrix, let's say, of socially responsible investing that we help our clients with. And again, PAX also is involved in shareholder engagement and advocacy through the proxy voting, the company dialogues, the shareholder proposals. Sometimes they will launch a shareholder proposal that's sort of a critique of company management. And then when the company leaders decide to go along with and make some concessions to what they're asking them to do, they'll actually withdraw the proposal. It's an interesting little dance that occurs in this whole process. So, okay, back to something that's very important to understand, which is unfortunately ESG as an acronym and a label has been utilized by many of the biggest firms out there, the Vanguards, the BlackRock folks who have a whole set of iShare, they're called iShare ETFs. A lot of them are branded with different variations of low carbon or ESG. But when you actually go to a search engine that tells you what they're actually holding, in many cases, it turns out that the carbon footprint is really not what they're focused on. So that's why someone like myself, the company that I have, Green River, we do a lot of work, and I'm going to go out on a limb here and say we probably do more work on a given person's portfolio than used to be done in the old days, where they just had this matrix and they'd sell you the S&P 500 tracking fund and a few other funds around it. Depending on what our clients' specific concerns and highest priorities are, we will focus around that and do a lot of research. And we'll make sure that if a fund says it's ESG, we don't just assume that that's true, or we don't assume that that means low carbon until we do the analysis. And I'll show you in a few minutes where we do that analysis, the sources for information that are free on the web. And that would happen to be an organization based in the East Bay called asyousow.org. And they've got 7 different search engines, but I just focus, our 2 priorities are first the carbon footprint. And so that particular site is fossilfreefunds.org. The one for the gender lens piece is genderequalityfunds.org. And why don't and this is just kind of, here's what you actually get on fossilfreefunds.org. Very, very robust set of data at asyousow.org. The one thing that they don't have yet is they don't have a way to analyze bond funds. They're trying to raise enough money to do that. The whole bond industry is completely different than the stock industry. It's much less transparent. And so the last time I was, we actually had the CEO of As You Sow on our last presentation. He explained that they just don't have the financial resources yet to do the bond analysis the way they do the stock analysis. So the fossilfreefunds.org search engine looks under the hood, compares the carbon footprint to each other and to benchmark indexes. And it's not just a negative screen. It also talks about how many of what are called the clean 200 companies are held by the fund. And genderequalityfunds.org, it looks at the gender ratio in corporate leadership. These are things we've already talked about. And let me see, and we also use Morningstar, as I referred to before. This is a funny little screenshot that I just stuck in here. So I don't know if you can see it very well, but I just wanted you to know that here is a place, Morningstar in particular, morningstar.com, for a very, very low monthly fee. You can get access to a heck of a lot of useful information that's, historical performance, how they assess their forward prospects, and then they have a set of carbon risk matrix, and they also show fossil fuel exposure within Morningstar. So here's that website that's focused around the fossil fuel exposure of a given fund. I've already got this preloaded with a symbol for one of the biggest and most common funds in people's portfolios. It simply tracks the S&P 500 index. And so it'll tell you right away, they have a letter grade system that I have some critiques of, but it's a quick way to kind of to get oriented. I look down here on the lower left at the percentage of the fund that's involved in fossil fuels, 6.53%. It's lower than it was a couple of years ago, and that's simply because all of those companies have shrunk in size and value. And anybody that tells you that divesting from Exxon doesn't have an impact on Exxon, they don't know what they're talking about. Where do you think most of the Exxon executives have the bulk of their wealth? Typically, it's in Exxon stock. So if by divestment we drop the value of their Exxon stock by 20 or 30 or 40%, you know darn well the executives are not real happy about that. And they also use their stock to acquire subsidiaries and lots of other things. So don't let anybody tell you that divestment doesn't have an impact. There's so much data on these as you sow searches. It's just really wonderful. I'm just going to show you the top line. So in this, you can see this actually tells you exactly what companies are held in the S&P 500 that are part of the fossil fuel universe. But we'll also look at the carbon footprint. They'll give you, a metric, a number, relative carbon footprint. They'll compare it to other indexes. They also tell you what the S&P 500, they give you a number for what their exposure is to the so-called clean 200. These are companies that are kind of leading the transition to a low carbon footprint economy. And yeah, Alphabet's in there, companies that you have heard of before, no question. 8.77% of the fund, which is really, it's just tracking an index. So this is kind of a proxy for U.S. investors in general. The S&P 500 includes something like 400 and some odd U.S. stocks and one or two foreign stocks. And it's used by many investors as a proxy in the U.S. So you can kind of get an idea of what it actually is. It's 6.5% exposed to fossil fuels. It's got about 8.7% exposure to the clean 200. So I'll just give you one quick comparison. One of the similar funds that we like to use is it's a Calvert fund. It's categorized. It's in the same general category as the S&P 500, which is kind of considered a blend of growth and value, American large caps. No fossil fuel holdings whatsoever. Carbon footprint much lower than the S&P 500. Exposure to the clean 200 higher than the S&P 500. 15% instead of whatever that last number was, 6 or 7%. So these are the tools that I use day in and day out for my clients when we're building portfolios and when we're switching portfolios around. And this site also gives you some performance numbers. Right here, you can see the annualized returns, and it'll compare to the, this is kind of like comparing to the fund we just looked at. So they're comparing this fund to the S&P 500, its relevant index. So you can see over 1 year, this fund is up 21% when the S&P is up 15%. And that's completely to be expected because 6.5% of the S&P 500 is fossil fuel companies that have all lost value this year. So naturally, they're not going to keep up with a well-managed fund that doesn't hold any fossil fuel stocks. The 3-year average, 21% compared to 12, that's unbelievable. And a 5-year average, because 3 years is a good time period to sort of look. That's when the transition to the low carbon international economy really started to happen quickly. So you can just see that the S&P 500 has been left in the dust utterly by people that were wise enough to get away from fossil fuel funds a few years ago. So here's the search engine for gender equality. And it's the same kind of process. You enter the symbol of a fund. They use a consultant called Equileap. Again, this is as you sow's process. So this is the process that they use when they're scrutinizing a Green Century fund or a PAX fund that claims to have really good gender equality. These folks at Equileap actually inspect as well, and then they come back with a rating. And so, here's sort of their list of criteria that they go over. And one of the many, many ways that you can use this site is to, every one of these search engines has a number 3 option, look for options that align with your values. So this is going from high to low. So you can see right here that the PAX Elevate Global Women's Fund has kind of the highest gender equality rank. And you can see that Green Century is in the neighborhood just as well. There's another sustainable fund family called Saturna that's in there. So this is the kind of information that we can get now at absolutely no cost that are created by this nonprofit called As You Sow. I really appreciate them and their search engines. Just wanted to give you folks a look at the tools that are available to all of us. It's not just for professionals. Anybody that wants to migrate to those websites can use that tool to their heart's desire. I just wanted to show you this site as well. Banking on Climate Change 2020. These are the latest details about which banks are making the loans to the fossil fuel industry. And as we all know, there we go, there's old Jamie Dimon, CEO of Chase. And this is just sort of a comparison. And this is, I mean, look at how far ahead JP Morgan Chase is. The next biggest violator is Wells Fargo, Citibank, Bank of America, et cetera, et cetera, et cetera. So go there, look around if you feel like it. It's you can really just Google Banking on Climate Change 2020 to find that out.
You have a question. How much impact on bank lending practices have consumers had?
So I think those things actually have had impact over time. And JP Morgan Chase has actually announced a few modest changes to their business practices just recently. So I'd like to think that these activists and letter writing campaigns, social media campaigns, I mean, I've done things on Twitter, email. You have to believe that over time, you know, that drip, 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 drip has a little bit of an impact. People talk about a performance sacrifice, and it's very clear that in 2020, the performance sacrifice is being experienced, whether they know it or not, by people that are holding S&P 500 tracking funds. Don't kid yourself. If you're holding anything with fossil fuel stocks in it, you're making a financial sacrifice this year. So just keep that in mind. There's a big transition in the investing world right now away from these kind of old legacy fund families that are gargantuan, very profitable, and just are so used to doing things the same way that it's going to take a long time for them to change. And meanwhile, the smaller, more nimble companies are going to be far ahead of them. The way we actually deal with our clients is, you know, pretty straightforward here. We have that initial meeting. We discuss financial position and goals. We make sure we're aligned. We don't work for people that who don't have, you know, generally, obviously, we're not always going to have the exact same priorities and criteria for our objectives, but we only want to work with people that understand that we're really in a climate emergency. Let's be honest about it. So we kind of get to know each other. And then really an important step is this risk tolerance questionnaire. And you can access ours either right from the website. On the homepage of the website, there's a little button to click, and you can take 5 or 6 questions, and we will just at no cost, no obligation, let you know what we think your ratio of your portfolio should be, stocks versus bonds and some cash. And that's really where, that's actually, believe it or not, one of the biggest indicators of your long-term performance. What is your stock bond ratio? Actions, not words, change the world. And I've been involved in other projects here in Marin when we've gotten together with the community, and people have decided to take a personal pledge to review your investment accounts. You know, after we've had this interaction tonight, try not to just forget about it and decide you're going to come back to it next year. Or even better, create a group like yourselves and make sort of a joint pledge to at least examine what you have and decide if it's appropriate to make some changes. And this is how most of us operate. We charge a percentage of the value of the account per year. And it's a sliding scale based on, you know, the size of the account. And so that's about it. That's it. Here we are. There's the website. Please feel free to visit. Jenny, anything that you can help me?
You know, I just think that's a lot of information to digest.
It is.
And it's a complete change in thinking about investing, and from just a passive form to actually something that's a form of advocacy for climate change. And I think you're a great resource, and your website's a great resource. And I can't thank you enough for sharing what you shared with us tonight, because I think people have a lot to think about, and they know they can reach out for you for follow-up questions, which I think is probably is where we're at right now.
Thank you very much.
You're welcome, folks. Take
So,
care.
I'd like to end with a prayer. And this one's specifically aimed at us at this time during the coronavirus outbreak. Let us pray. Lord Jesus Christ, you taught us to love our neighbor and to care for those in need as if we were caring for you. In this time of anxiety, give us strength to heal your creation, to comfort the fearful, to tend the sick, and to assure the isolated of our love and your love for your name's sake. Amen.
Amen.
Again, thank you, Patrick, and everybody stay safe, and we'll see you hopefully in 2 weeks.